And now, in studio, bringing his Midwest values from the Show Me State to the land of San Diego. He's a triple threat, licensed as an attorney, mortgage broker, and a top producing realtor who's crushing the competition. Here to deliver you what's happening in the trenches of the market. Your host, Michael Gaddis.
Welcome to the Michael Gaddis Show on AM 1170 The Answer. I am Michael Gaddis, the host of the show. I am a licensed California attorney, a real estate broker, and an MLS licensed mortgage originator. I'm a little unique in that I do have all three of those skill sets. A lot of times you can find a real estate broker, and sometimes you can find a real estate broker that's also an attorney, but it's very rare to find one that has all three of those skill sets. So we have a great show today, but before we get started, let's do a little housekeeping. Again, my name is Michael Gaddis. My toll-free number is 888-242-2272. My email address is michael@michaelgaddis.com, and my website is www.michaelgaddis.com. As I mentioned, we have a great show for you today. We're going to talk about everything from distressed housing to is there a housing bubble and will it burst? How buyers of real estate find the properties they are looking for, and should you refinance or stay in that adjustable interest rate loan? First up, we're going to talk a little bit about some items in the news. As I mentioned earlier, some housing experts are predicting that San Diego's housing bubble is poised to burst. In an article in the Times of San Diego, it says some parts of San Diego's real estate market are entering into bubble territory and could pop in the next recession. This is according to University of San Diego real estate expert Norm Miller. He's talking about how the tech industry might have some influence into basically what happens with our housing market. And this is an interesting article because of what happened this week with the Dow losing 1,000 points in a day. It's a kind of interesting timing. You kind of combine that with another article that was written recently, and it said San Diego housing prices up 4.6% in June. So we're nearing a time when the housing prices for the San Diego County are almost where they were, at least the median is almost where it was in 2007. And to be honest with you, that's a little bit alarming because when you're talking about, people, predicting bubble bursts and housing prices continue to rise. And then KPBS actually issued on August 11th, they wrote an article. It says San Diego County housing affordability down to 25%. And this article is really interesting because it says to afford a house in San Diego County, where the median house price is about $548,000, a household would require a minimum annual income of $108,390 to make a monthly payment of $2,700, which includes principal, interest, taxes, and insurance. And that number was based on a 3.95% interest rate. So what's interesting to me is, first of all, I'm originally from Missouri. So, when I start hearing how much these houses are worth, it just boggles my mind. I mean, a $548,000 in Kansas City, Missouri is huge. I mean, it's amazing. And when you go around and look at houses and what you can get in San Diego for $548, it's just remarkable. But what's even more remarkable than how much the median house price is how much money it takes to qualify for a loan to buy one of these houses. And, back in the early, the early part of the 2000s and such, mid 2000s, the banks had a lot of programs out that a lot of people took advantage of, as we all know, stated income loans, 100% financing, a lot of those types of, option arm loans, those types of loan products, made it easy for people to qualify for homes. But the pendulum has swung since then. We all got slapped on the hand and the housing market took a crash. But yet here we are, we're going back to a median house price that's almost equivalent to where it was in 2007. And the lending has changed considerably since then. In the past, it was basically, you write how much money you make on a 1003, loan application. Now they criticize and critique every single thing that you do. So it's all full doc. You bring in your tax returns, you bring in your pay stubs, you bring in everything, and people would, just as it said, it would require a monthly income of $108,390. Now, I'm assuming, I did not write this article, but I'm assuming that there's no other debts involved either in order to do that, because when you qualify for houses, there's what's called debt to ratio analysis, and a DTI basically takes into consideration your housing ratio, which is principal, interest, taxes, and insurance, and basically adds it to your existing revolving debt. So if you have car payments, credit card payments, things like that, that gets added into it, and you have to have a certain amount of your gross income has to be there for you to be eligible to purchase a house. So what's remarkable is that it says San Diego County housing affordability down to 25%. Basically, just 25% of the people who live in San Diego can actually afford to buy a house, according to this article. So that is really, really an interesting thing to think about. So the big question I'm always asked is, are we on the edge of another big housing bubble? Are we ready? I'm going to wait and buy a house until the market falls out again. Well, here's the deal. The market might take a little bit of a tumble, as the first article indicated. However, it is not going to be anywhere near, in my opinion, to what it was back in 2008 and 2009. And the reason is for the reason I told you earlier. Those loans, the financing that basically held those houses up, the market up, was like a house of cards. It was empty financing. These people there was no underwriting that went through and made sure these people were making the money that they said they could. And what happened was a lot of these people were on 2 and 3 year interest only loans. That's the other thing I forgot to mention, the interest onlys. So they were on 2 and 3 year interest only on teaser interest rates. And what happened was that when they started to adjust, they were adjusting very high, because back then, and we'll talk a little bit more about this later, but back then the indexes were really high. So they were going from teaser rates, and if you could see me, I'm doing air quotes in the studio right now, teaser rates of around 6-7%, and they were going up to 9 and 10%. Well, these people had no skin in the game. They did 100% financing, and when the banks took away the 100% financing programs, and then they pulled the carpet out on the stated income, these guys were stuck. They had nothing. They either had to suck it up and pay them, the increased interest rates and payments, or they had to leave their house. And to be honest with you, most of these people were not equipped to handle such an increase. So that is kind of why, they had no skin in the game. It was very easy. Well, emotionally it wasn't easy, but it was very easy for them to say, okay, I can't do this, and walk away, which started a domino effect. And then pretty soon we all know what happened after that. Nowadays, it's not like that. As I mentioned, the people that are buying these houses now are based upon full doc examinations, so will a tech, something in the tech industry or some other type of, world-related issue, could it affect the housing market here? Yeah, it will, but it won't topple it quite like it did before. It's going to be, because most of our households are 2-income households when they qualify. So if one of the households goes down, it's going to put a lot of financial strain on the household in general. And it could cause, people to abandon their housing, but it's not going to be like in a mass exodus like it was before. So to answer the question, will there be a catastrophic housing bubble in the near future? I doubt it. As I said, it could take a few steps back, but it's not going to be, in my opinion, anything like it was before. So, and, if you look at the articles and they say that, the housing is still, last week I told you that the inventory in San Diego is the third lowest in the country. Third lowest in the country. Only Charlotte and San Antonio have a lower inventory. So the demand is still there. It's still a seller's market. If you're a seller, you better sell now. Don't say, I'm going to wait for a couple months. Don't do that. Sell now. Sell while the market's hot. Sell while there's a lot of buyers out there still. So now there is another thing I mentioned last time, Toll Brothers at Robertson Ranch, which is building an enormous housing development up in Carlsbad, which is going to help with the lack of supply. There's another 300 home development coming to Rancho del Oro and Oceanside, which is going to really help out with the affordable housing as well up in the North County area. It's up there. It's going to be called Pacific Ridge, and it's being built by Cornerstone Communities, which is a San Diego-based developer. So we have a lot of new housing developments popping up all over the place. So that's always a good sign for the housing industry. Whenever you see those big earth movers moving earth around and people, getting land ready, and you see a lot of new housing developments going up, that means that a lot of the developers are banking on the fact that the housing market is going to remain strong for a while. And usually they're right. I mean, and I think that in this case, they are, because the statistics don't lie. There is just generally a lack of inventory in San Diego. And what's remarkable is that, the San Diego housing prices continue to rise. I mean, it's incredible how much the prices of these homes are increasing. I'm looking at an article right now written by Roger Sholey and of the San Diego Union Tribune, and he says, that the Case-Shiller Index is up 4.5% nationally from 2014, and it's up 4.6% in June. I mean, it's incredible. I mean, the fact that we're nearing such a high median house price, and they're still going up. So, as I mentioned, this is your window of opportunity if you're a seller. Hello, sellers. You need to think about selling. You need to sell if you've been thinking about it. So, after the break, we're going to talk a little bit more about distressed housing. I mean, are there still is there still distressed housing out there? And are there things called loan modifications, which everyone's heard of, and short sales? We're going to talk a little bit about that after the break.
San Diego's home for intelligent, conservative talk. AM 1170. The Answer.
Craig Sewing here, host of The Craig Sewing Show. I want you to think in your head for a minute. How much money did you make last year? Here's a better question. How much money did you keep? In other words, how much of your hard-earned money was for you rather than giving it away to this inefficient government of ours? If you think the government's inefficient, I got a challenge for you. I'm going to challenge your efficiency with your tax plan. My good friend Doug Jennings, who you hear on KCBQ all the time, is a savant when it comes to tax planning. As Doug puts it, Craig, I've never even seen a tax return I can't improve. Doug can help you keep more of your money, help you improve your structure for your taxes, your business, your real estate, even your marriage. Why wouldn't you take a moment to get a free consultation? It can save you thousands, maybe tens of thousands of dollars. He's not really a friend of the IRS, but I'm a consumer advocate. I want him helping you. This is something you got to do. Visit JenningsTaxLaw.com for a free consultation on your tax plan. That's JenningsTaxLaw.com. You can thank me later. Doug is a great person, a great professional. He and his wife Peggy are friends of mine. I give him my highest recommendation. JenningsTaxLaw.com. Visit him today. Hey, Craig Sewing here, consumer activist. You hear me every day at 6 p.m. on KCBQ. My goal is to help you win in any marketplace. One of the things that applies to every single person that listens to our show and that's listening right now, you have a credit score, and more likely than not, it has inaccuracies on it. Nobody seems to understand how these things work. Here's what I can tell you. I have a credit expert that's a partner in the show named Aran Sinai. I call him the credit magician. If you've ever had any issues with your credit, you want to get your scores up, maybe a foreclosure, bankruptcy, or maybe just a collection. The city of San Diego can send parking tickets to collections. Crazy. Well, bad credit's a choice. Reach out to Aran Sinai. How do you do that? You go to our website, AmericanDreamElite.com. AmericanDreamElite.com. Hit me up on the contact form. I'll connect you with Aran. AmericanDreamElite.com. If you've ever had any credit issues whatsoever, AmericanDreamElite.com.
Welcome back to the Michael Gaddis Show on AM 1170, The Answer. Right now, we're going to talk a little bit about something right in my wheelhouse. We're going to talk about distressed housing. In my legal practice, this is what I specialize in. I specialize in helping homeowners who are having trouble with making their payments on their home loans. So I want to talk a little bit about that. I mean, some people say, is it still out there? Are there still people having problems? Yes, there are. While the numbers are significantly less than what they used to be, there still is a great need for assistance for people who are in danger of losing their home. So typically, when a homeowner begins to have problems with their loan, when they call me initially, the first thing we do is I have kind of like a waterfall I go through. The first thing I do is I analyze them to see if they could qualify for a refinance, maybe to help them out of it. Now, of course, most of the people who call me are either underwater on their loan or are late, so it will eliminate refinance. But I still go through that because if there is a way to refinance them, that's usually the best and easiest and most sure way to try to solve the problem. Now, some people do call me who have equity in their house and they're struggling and in danger of losing it, and that's exactly the first thing we look at. Now, if a refinance doesn't work, the second thing that we look at are loan modifications. Now, everyone has heard about loan modifications since 2008. They hear that term, and everybody in the world's an expert at loan modifications. I'm sure your next door neighbor's an expert, the guy at the gym, everybody knows about loan mods, but here's the truth about them. First of all, lenders are not required to give you a loan modification. Loan modifications are a loss mitigation tactic used by the lenders to prevent losses for their investors. That's what it is. So it's kind of funny whenever the bank sends people out who are missing their payments. They send them letters saying, "Hey, we're here to help you." No, what they're really there to do is assess you. They're there to assess your financial worthiness to see if there's a better way for them to mitigate the losses. So that's what they are. They're not there to help you. They're there to help their investors. So what is a loan modification? A loan modification is basically a change to the terms of a note. So let's say you have a 6% interest rate and you have 21 years left remaining on your term. A loan modification can go in there and use use different tools. They could do rate reductions, principal reductions, amortization extensions, term extensions, balloons, forbearances. There's a lot of ways for them to restructure the terms of the loan, reset it, and get you started again. But, it's not as easy as it seems. And I think everyone hears horror stories. Well, the banks never give loan mods. I had a guy yesterday who called me, banks never give loan modifications. Yes, they do. They do. It's not easy. It's a difficult process, but they will give them if you meet the criteria. And it's all about underwriting guidelines. Let's put it this way. Every single loan modification has 3 parts to it. 3 basic parts. The first is a hardship analysis. What they're going to do is they're going to find out what's your reason for being late. What's the reason for your asking them to do something different? Now, sometimes there's a presumption of hardness, let's say, of hardship. Let's say you're, 3-4 months past due, 5 months past due, or longer. Well, there's almost a presumption that something unusual is going on, so the hardship analysis is not usually that, overly difficult. However, if you start approaching the lender and you're current, and you're like, well, I'm having difficulty with my loan, they're going to put you through a hardship analysis. They're going to ask you what your problem is, and they're basically going to assess you to see if whatever hardship you're incurring is within their investor guidelines to address, because they don't have to give loan mods. And so they're doing it because there's a risk of danger, and they want to see if the risk of loss to them is great, because ultimately that's what loan mods are. It's an assessment of risk of loss. So once you get through the hardship analysis, the second phase is what I call the financial analysis. That's where they take your loan application and they basically look at it in comparison and in relation to what their underwriting guidelines are. And what I mean by underwriting guidelines are that basically lenders have investors that actually own the notes. The investors give the lenders rules on what they can do with loans that are in default. Some lenders have more tools available than others. For example, some will allow for interest rate reductions, while some will not allow for interest rate reductions. Some will not allow for capitalization, some will. So it just depends on what the rule book is for the investor. Then they take your financial package, look at the rule book, and basically try to put it together to see if there's any type of proposal they could put down that would fit the criteria. Now, say they say, okay, we've got a proposal. Well, what they do with that proposal is they basically put it into the third test. The third test is called the net present value, NPV, Nancy, Paul, Victor. Now, I'm sure anybody who's listening to this show right now who has tried to get a loan modification and been denied has heard the term NPV. Now, and they probably didn't know what it was. Immediately, everyone think it has something to do with your value, which is not necessarily true. The value is a component of the NPV, but it's not the end all. So what an NPV is basically it's a computer test that basically takes into consideration all the data related to your situation. It has probably 50 fields of data, and it basically determines whether the financial the proposal set forth in the financial proposal is in the financial best interest of the investor. Everything has to be in the financial best interest of the investor. So if giving you, say, a 2% on a 40-year note, amortizing it over 40 years is in the financial best interest of the investor, you will be approved. If it is not, you will be denied. Now, once you get denied, you'll receive a denial letter. It'll say you were denied based on NPV. You, of course, will get very angry. You will say, why is that? I don't understand. The life isn't fair. The banks aren't fair. Nobody's fair. But that's the first what you're going to say. And then you're going to get a letter that's going to have, 50 fields of data in it. Now, the first thing you need to do when you get that letter is you need to go through every single field and make sure that every single field is correct. You need to make sure that there's no errors in the fields. Now, assuming that there are no errors in the fields and everything is accurate and you're failing NPV, it might be difficult at that point to do anything about it. Now, the key in my world is to make sure that the bank is doing what they're supposed to be doing. And because, I've been doing this for so long, since 2008, I know a lot of what the banks have to do. I know their rule books. So a lot of times they're not applying the rules correctly. They're not calculating income correctly. They're discounting income. They're, denying because you're unable to produce a certain document. There's a lot of different reasons why you could be getting denied. And people always ask me, what's the reason that you're good at helping people with this in this situation with loan modifications? And I always tell them, I say, it's not because I'm an attorney. It's because I'm an attorney that also is a real estate broker that is also, basically a mortgage broker. So it's the mortgage side. It's the finance understanding that really helps me help people. So, some of the issues that could cause people to fail are if your value is high. If you have equity in your home, it's very difficult to get a loan mod. Your odds go down because the risk of loss to the investor go down. If you have excessive delinquencies, that's very difficult. If you're 48 months or more past due, it is difficult. Not impossible. I modified somebody who was 92 months past due. 92 months past due. I got them a very, very good loan modification, but it's not easy. Sometimes another reason is you can lack or have too much income, or owning multiple homes could be problematic. And if you've had too many loan mods, if you've had, three loan mods already and you're coming up again, it's almost impossible at that point in time. But, if you're in that situation and you're struggling and you don't know what to do, you should definitely give someone like myself a call or contact someone's office, somebody who knows what they're doing, who really understands loan mods. Now, assuming that you cannot necessarily qualify for a loan mod, another loss mitigation tactic are short sales. Now, short sales are ways where basically what you do is you sell your house and settle the loan for less than the agreed upon amount. Now, this is really important, especially for people who have junior liens that are recourse loans, meaning they're non-purchase money loans where the loans can come after you. Let's say the first forecloses and you have a $300,000 second. Well, this is a really important tool that you can utilize to basically negotiate yourself out of any liability on that. The debt owed on that second lien. You can also preserve credit. And I don't know if any people know this, but if there's anybody out there right now driving or sitting at home right now and you short sold your house within the last 12 months and you're a veteran and you have VA eligibility, it's really possible you might be able to buy a house, within 12 months after a short sale. So if you're sitting there listening and you go, oh man, I short sold my house 3 months ago, you need to really think about that. You might be back in the game much quicker than anybody else. So They also, the other thing about short sales is they have some pretty lucrative incentive programs. A lot of banks participate in HAFA, which is the Government Short Sale Assistance Program, and they can give up to $10,000 in relocation assistance. So that really helps out. That goes a long way. I mean, it's emotionally, it's very difficult to let go of your house, but if you have the ability to get some money to help bridge you into your next situation, it definitely does soften it a little bit. But short sales are difficult. They're not easy, and they're getting more and more difficult to do. So if you're going to use somebody to short sell your house, you need to make sure you use somebody who has the ability to handle them. You know, every real estate person in the world is going to tell you they're a short sale expert, and every single one of them is going to tell you they can handle any situation that occurs. But I will tell you they cannot. There are some crazy situations out there. Banks with appreciating values, banks are getting more and more difficult to deal with. You could have HOA liens, you can have judgment liens, you could have the bank fighting you on values. I mean, there is so much involved with short sales that you really need to find someone who's a short sale expert. So if anybody's out there is thinking about, getting a loan modification or about, considering a short sale, you should really, really contact my office, again, at 888-242-2272. Or you can email me directly your scenario at michael@michaelgaddis.com. That's michael@michaelgaddis.com. And I'll be take a look at your situation, and we'll see what really is going on, and if there is a way to potentially save it. Because when it comes down to it, I understand the emotional side of losing a house. I have been doing this since 2008, and I have helped countless homeowners get through very bad situations. People like myself are guides in in these situations, and my goal is to try to get you out of a bad situation and into a different situation with as little pain as possible, using all the knowledge and expertise that I have. So I will be glad to take anybody's scenario and kind of run it through them and see if there's anything that we can do to help. Well, when we come back from the break, we're going to talk about a little bit about the National Association of Realtor Statistics on how home buyers are finding homes. Where are they looking, and how are they finding homes?
This is AM 1170. The Answer.
Hey, San Diego, Craig Sewing here. Look, one of the things that nobody likes to hear is that they got bugs in their home. Almost all California homes have some sort of bug or termite problem. It's not a cool thing to have bugs running around your house, so I'm going to help you get rid of them. I want you to connect with Lloyd's Pest Control. These are our good friends of the Craig Sewing Show. They can help you. They've been in business putting bugs out of business since 1931. They'll do a free inspection for you. If you want to get your biggest investment checked out, make sure there's not bugs or termites, go to LloydPest.com. That's LloydPest.com and get a free inspection of your real estate today.
Going through divorce can be very stressful. It is important to know your rights. I'm attorney Ilona Antonian. I'm a certified family law specialist. For over a decade, I've been helping San Diegans win their divorce and custody cases. If you have questions about divorce, property division, child or spousal support, modification of orders, or find yourself in a custody battle, please call us at 619-696-1100. Find us online at expertdivorcelaw.com, where you can download our free divorce, mediation, and recovery guides that I hope you find useful.
Welcome back to the Michael Gaddis Show on AM 1170 The Answer. Again, I am your host, Michael Gaddis. I am a real estate expert. I am also a licensed California attorney and an NMLS licensed mortgage originator. So I have the three skill sets to really handle just about any situation that might arise during a real estate transaction. But one of the things I enjoy the most out of everything that I do is selling real estate. It is my passion. I love it. And I'm a statistical man. So when in my real estate practice, one of the things I do is I analyze data and statistics. So I want to know where people are looking, how are buyers coming around trying to find the homes, because it helps me tell me where I need to advertise and help my clients market. So one of the things I look at is a report issued by the National Association of Realtors. It's called the Home Buyer and Seller Generational Trends Report, and the one I'm looking at was the one for 2015. And it's interesting because when you look through the statistics, and this particular report has statistics broken down overall and by age. So let's take a look at the home search process. What is the first step taken during the home buying process? So when someone's going to buy a house, what's the first thing they do? Well, according to this report, 43% of all buyers looked online for properties for sale. So that's the first thing they did, was look online. Now, actually, that's a little bit skewed because the next statistic says looked online for information about the home buying process, and there was 12% did that. So if you add those two together, 55% of home buyers are looking at the internet in some way. And what really is interesting about this statistic is if you look at the ages, 34 and younger, 44%, 35 to 49, 46%, 50 to 59 years of age, 43%. Let's jump up to 69 to 89 years of age, 32%. Everyone is going to the internet as one of their first sources of resources for buying a home. So what does that tell us? That tells us that when we're marketing our homes, we have to have a very, very good internet presence. You need to retain the services of a real estate professional that understands the internet. Let me show you a little bit, because you're going to have a lot of people pitching a lot of different things. But let's put it this way. Looked in newspapers, magazines, or home buying guides. Do you know how many percent? 1% of people, according to this study, that was their first source they went to look for. So, that's a really, really, really important thing to think about, because there's right now, according to this, there's another study they had here, and it says information sources used in home search. So these are the different sources that people use to help find it. Not the initial source, but just the sources in general. 88% online website. Okay. 87% real estate agent. Yard sign, 48%. So 48% of home buyers looked and used a home sign to help them buy a house. Now, let's go to open houses. Only 44%. So the internet is double the amount of efficiency than an open house. Let's go down to print and newspaper advertisement, 21%. Only 21% look to the newspaper to help find their house. And home book or magazine, 14%. So what does that tell us when we're calculating how we're going to market? Well, what we do is we market where people are looking. We do not market where people are not looking, because it's a waste of energy and resources. So when you look down here at the bottom, it says home book or magazine, only 14%. That kind of tells you maybe that's not the place that you really want to concentrate a lot of your activity on. So in my world, as I mentioned, I'm very focused on the internet. Search engine optimization, ways to utilize ancillary sites. Whatever it takes. I want to have a good web presence for my clients, and that takes a lot of work, because you got to understand how the mechanisms of Google and the other search providers, how they work, and how you're supposed to get your properties up there as much as possible. And there's another chart here. Basically, it's where buyer found the home that they eventually purchased. So this tells us when they purchased it, where did they find it? 43% of the people found the home that they eventually bought on the internet. The next highest was 33% from a real estate agent, and then it dropped significantly. 9% for a yard sign or open house sign. 6% for a friend, relative, or neighbor, 5% for a home builder or their agent, 3% directly from sellers, and 1% that they knew, 1% from print newspaper advertisements, and it was less than 1% for home book or magazines. So the statistics are telling me that basically the important resources for people buying houses are real estate agents and the internet. So you have to find a real estate agent that really understands marketing on the internet. That's the way the real estate industry is going. That's the future of real estate. It's being able to market on the internet. Now, I know what a lot of people are thinking. Well, if I can do it on the internet, why do I need a real estate person? Why do I need a real estate professional at all? Get that right out of your head. You definitely need a real estate professional. Buying a home is an incredibly complicated thing. And it's something that if you're not familiar with it, you can't pick it up in one of those Selling Your House for Dummies books and really understand it really quickly. You've got to really know the ins and outs of it, because if you don't, you could really open yourself up to liability. And one of the things I really want to talk about is basically make sure you have a good buyer's representative when you are buying a home. You need to find somebody who is strong, passionate, and committed to basically representing you. You need your own champion in the transaction. A lot of people think, well, I'll just go directly to the agent that's selling the house, and then I'll just have him do both. When you can do that, that's fine. That's called dual agency. However, I am of the belief that you need your own champion. You need your own person that can go and has your best interests in line. Let me give you an example. Let's say you're purchasing a house, and let's say you go and you use the same agent. He's representing both sides. Well, let's say during that transaction, you're coming up on your loan contingency, meaning after 17 days, actually it's 21 days now, after 21 days, you're supposed to remove that contingency, which means that if you remove the contingency, you'll lose your deposit if you can't get your loan. As long as that contingency is in place, your deposit is protected if you can't get the loan. Well, let's say 21 days comes up, you're having trouble with your loan. You go to your agent, who is also the seller's agent, and say, hey, I need you to buy me some more time. I need a little bit more time to get my loan in order. So that agent goes to the seller and says, hey, he needs some more time. And he goes, forget about it. I want those contingencies to removed, or I want you to issue a notice to perform. Now, who is that agent going to fight for? Are they going to fight for the seller to give you more time? Are they going to fight for you to go to the seller to get more time? Or are they going to fight for the seller and push a notice to perform on you? It's an ethical dilemma that can create problems, because you need someone that's going to be in there committed to try to whatever it takes to convince them to give you the additional time if you need it. Because if you release that contingency, your deposit could be at risk. So, I'm just giving this as an example of why you really need to have it'd be better to have your own advocate in a situation rather than just relying on, the person that's there, or, even doing an FSBO. For sale by owner, you can get yourself in a lot of different legal issues there as well. So, and home sellers too. When you're listing your house, I get it. You can you can list your house online, but it is so complicated. You should sit in my office for one day and listen to the phone calls I get from people who are complaining about their agents. Well, this agent's doing this. Or an FSBO seller says, well, they're trying to pull this. I get these calls all the time. And you know what the simple solution is? You should have hired a good agent. Not just any agent. There are 20,000 people that have real estate license in San Diego County, okay? Literally 20,000 or more. So, do you think all of those people are the most real estate professional type people? You need to get a real professional. Someone that understands the ins and outs of marketing, someone that understands the ins and outs of the paperwork, somebody that's got your best interests in mind. Now, with that being said, I want to jump over to my listings of the week. I have 3 listings of the week I'd like to talk about. The first is located in Alpine, California. It's 707 Camino Scarpita. It has 4 bedrooms, 3 baths, and 3,227 square feet. It was built in 1995 and is a custom-built home with panoramic views. Canyon and valley views. This is an amazing lot. This is literally an entertainer's dream. This thing has a little vineyard. It has a bocce courts. It's got horseshoe pits, an outdoor barbecue. Literally, you go to this house, you never want to leave. It is an amazing, amazing home. So if you are thinking about moving to Alpine, you really need to call my office really quickly, because it's listed right now at a range listing of $679 to $699. The next listing I want to jump to really quick is 4251 Pylon Point in San Diego, California. This one is located in Carmel Valley, and this is literally, if you want to live in Carmel Valley, you got to call me now. That area has such a, I know we've talked about lack of inventory. There's a huge lack of inventory, and this is a steal. Okay, it's at $390 per square foot right now. I mean, it is at least $10 to $12 per square foot cheaper than any of the other homes in the area. And get this one has no HOA and no Mello-Roos. So I'm telling you, should I say that again? No HOA, no Mello-Roos. So it's a rare opportunity. It's a 2,533 square foot home, 4 bedrooms, 3 baths. That fourth bedroom is upstairs. It's so huge, you could literally divide it into 2. In the downstairs bedroom, there's a bathroom right next door to it. You could open it up and have open the wall up and have an ensuite bathroom, ensuite. It is an incredible opportunity. So if you're interested in Carmel Valley, give me a call. When we come back from the break, we're going to talk a little bit about loans and should people who have adjustable rate loans refinance now or keep riding it out? We'll be back after this.
Saying, I don't know, is no longer acceptable. This is AM 1170, The Answer.
What if you could safely grow your retirement account with a reasonable rate of return with no risk of principal? Hi, this is Dave Harris with Wealth Preservation, specializing in retirement income and insurance planning. There's nothing I enjoy more than helping San Diegans protect and grow their retirement savings. For over 4 decades, we have helped families achieve financial success. If you need help with your retirement planning, please visit me online or call me today. My number is 800-313-PLAN or visit me online at wealthpreservationllc.com.
Hi, this is AJ Gupta from the Gupta Legal Center. You've probably seen us on the American Dream TV show and the Craig Sewing radio show. We're honored to be featured as the exclusive real estate attorney and honored to be trusted by Craig and all of his top producing realtors. Our office was also featured as a super lawyer representing California's top 5% of attorneys. You may not know whether you need an attorney or not. My suggestion is you kind of have an idea whether there's a problem or a question. So I suggest if you don't know whether you need an attorney or not, give us a call. We're happy to pick up the phone, give you a call back, figure out what it is that you need to have addressed. If we can't or don't know the issue, then we can definitely point you in the right direction. Our phone number is 619-866-3444. That's 619-866-3444, and that's GuptaLC.com. GUPTALC.com.
Hey, Craig Sewing here. Look, I get asked all the time from CraigSewing.com, who is my CPA? I got to tell you, this guy is the savant of tax planning. He's not just a CPA that does all the paperwork. He will actually help you coordinate a full-blown tax plan and asset protection. I have never referred anybody to Doug Jennings that was not able to reduce their taxes. Not once. And I've never heard anything negative. I give my highest recommendation to Doug Jennings at JenningsTaxLaw.com. You got to reach out to him, a free consultation, and you'll see you might be able to cut your tax liability in half. Ethically, legally, it just takes a plan. Doug Jennings, JenningsTaxLaw.com. Reach out to him today, JenningsTaxLaw.com.
Welcome back to the Michael Gaddis Show on AM 1170, The Answer. I am Michael Gaddis. I am a top producing real estate professional. I'm a licensed California attorney and an NMLS licensed mortgage originator. I am very unique, and that's not bragging, that's just the truth. So, a couple things before we move on to the topic I talked about right before break that we were going to discuss, which is adjustable interest rate loans. I wanted to mention one thing about Carlsbad. My base of operations is in Carlsbad, California, and I read an article on the Times of San Diego that said Carlsbad makes list of 10 hottest U.S. real estate zip codes in the country. And I'm looking at this list right now, and I believe it's the only one in California that is on the top in the top 10. It's amazing. And the ranking is based on the time it takes properties to sell and how frequently homes are viewed online by Realtor.com. So they're saying that the zip code is 92010, east of Interstate 5 and north of Palomar Airport Road, which is my backyard. That's right, guys. This is my backyard. And, so I'm really proud of Carlsbad. It is a great place to live. And as I mentioned, this is one of the hottest markets, and there's a lot of reasons for that. So if you haven't visited Carlsbad, you should take a drive up there and look at it, and you'll understand exactly why this made the list above any other place in California. So I read another article online that said that basically 1/3 of mortgage holders do not even know their interest rate. And I could not believe that statistic. 1/3. But I tested it. Last night I asked my wife, who pays the bills, what is our interest rate? And she said 4.5. And I said, wrong. Our interest rate is 3.5. I have a 3.5 30-year fixed. And I said, you just proved my point. Of course, she's embarrassed and would kill me if she knew I was telling everyone that on there. But it does prove the point that a lot of people don't even know what their interest rate is. And I find that just amazing to me. Now, at the beginning of this year, everybody was basically, predicting that the feds were going to raise the interest rates by the end of the year and the interest rates would start going up. And that prediction started to run true in the middle of the year, around May and June, into May, June. You started seeing hikes in interest rates, and we had some tough times there, especially with people who are floating their interest rates, waiting to lock their interest rates. And, so it was a little bit tough there for a while. But because the stock market is having so many issues and the problems in China and around the world, and there was another article that was just written yesterday, and it says stock market hit expected to keep interest rates for homes low. That is good news, because I'm going to tell you something. All of you people out there and I'm waving my finger right now, so if you don't, I'm waving my finger. All of you people riding on your adjustable rate interest rates because you think you're adjusting really low. If you have not refinanced yet, you just got a reprieve, because those interest rates were on their way up. And right now, you might have an opportunity to refinance into a 30-year fixed rate that is a very historically low interest rate. I'm telling you, so many people almost missed this boat. And I'll tell you why. The way interest rates, adjustable rate mortgages, they're called ARMs, are basically loans that have fixed rates for periods of years. After the expiration of the fixed interest rate period, the interest rate starts to adjust according to the terms of the note. Now, interest rates adjustments occur by two factors. One, there's a margin, and then there's an index. The margin is a set amount that is basically in your loan docs. It's in a document called the adjustable rate rider or rate adjustable rider. It's a set number. Now, that set number is added to an index. The index changes. It changes all the time. And so for a long time in recent years, the indexes have been super low. In fact, let me give you an example, because most people don't pay attention to these. But let's say homeowners, if, for example, in June of 2006, if an index of 2.25, which is a good margin a margin of 2.25, and a margin of 2.25 is a pretty good margin. I mean, they range anywhere from like 2 to 2.5, but usually it's around 2.25 is a pretty solid margin. So if you had a 2.25 margin in June of 2006, and you were on the 1-year LIBOR index, that means that's the index that the bank is going to go to add that number to your margin. In 2006, the 1-year LIBOR index was 5.69. which meant that if you adjusted at that time, your interest rate would be 7.94. So remember earlier in the show when I was talking to you about all those people who were on those interest-only loans and they were adjusting, and that's what was happening to them. Their margins were so high, and I'm telling you, a lot of those people, just to go back for a minute, those people did not have 2.25 margins. They were sold margins like in the 3s and the 4s. So, I mean, a lot of times people go, well, the homeowner should know what they're signing. You know what? I asked a bank representative once, why don't you come here and bring your home loan docs and I'll test you on yours to see how well you know your loan docs. They're very complicated, very difficult to read. So, so all these people had those terrible margins. But even if you had a good margin in 2006, you would still be adjusting to a 7.94. If you had that same interest margin today, in August of 2015, the index right now, the 1-year LIBOR, 0.84. So let me say that again, 0.84. So the margin in the index in 2006, 5.69. Right now, 0.84. So if you adjust today, your interest rate would be around 3.09 if you had a 2.25 margin. So what's happened is, and actually that index is up a little bit because it's been lower than that. So what's happening is everyone who's been adjusting, See, the people who had the horror stories about who adjusted back in the 2006, 2007 when the margins were high, it was like horror for the they get that notice in the mail of adjustment, and like it was literally like somebody punched them in the stomach and they lost all the wind out of it. It was just horrible. But now, after the indexes dropped, all these people that started getting these adjustments and their payments were going way down, and they're like, well, I like that. Why should I do anything? Even though the 30-year fixed rates were dropping, they said, well, if my interest rate's going to be 3 or 2.89 or something like that, why don't I just take a chance? It's only adjusts once a year. It's on the 1-year LIBOR, so that's what it means. It adjusts once a year. So it adjusts once a year, so I can take a chance. I don't need to refinance into a 30-year fixed. Well, you know what? A lot of those people played, I call it poker. They were playing poker, and it worked for them. So it's worked for many years. However, the interest rates are not going to stay down forever. The indexes aren't. And if you look at the historical trend of the index, and if you're near a computer right now, just type in, LIBOR index, 1-year LIBOR index history. You'll see the graph of how these things go up, they go down, they go up, they go down. You need to take advantage of it while it's down. I originally come from Missouri. It's a very conservative state. Everybody I know is fiscally conservative. So they're like, well, you need a 30-year fixed. Well, a lot of times I think, well, you're being a little over the top. But right now I think they're right. I think the 30-year fixed rates are so low, you need to take advantage of them before the indexes go up and you start adjusting up, and then you're going to be stuck. And then you're going to be regretting the fact that you did not jump onto that 3.5 or 3.875 or 4% train, whatever it is right now as of today. Because for those of you who do not know about interest rates change constantly. Sometimes I get notices of interest rate adjustments 2 to 3 times a day. They could either deteriorate or increase. It's a very, very fluid market. So until your interest rate is locked, it is always subject to change. So, and people, it's really like the stock market. So sometimes I'll have somebody into my office and they're saying, well, we'll think about that 30-year fixed. And I'll say, well, think about it, but just keep in mind, it does change, and it could change before you make that decision. Sometimes I think people think, well, you're just trying to sell me. You're just trying to close this deal. I'm probably one of the most transparent people you will ever meet. You'll come into my office for a refinance or anything. I will sit down there. I will plop rate sheets. I will plop you will learn more about how loans work in 30 to 40 minutes of sitting with me than you have known your whole life. There's no way you could learn more on the internet than what I can teach you in that amount of time. So I'm an extremely transparent person, and I don't BS people. So it's kind of like, if I tell somebody, look, it's very possible it could change, and there are certain market indicators which kind of give us ideas. You can never really predict 100% where the interest rates are going to go, but you can look at, the bond market and a bunch of other unemployment reports, and a lot of those things will directly influence where interest rates are going to go. But in the end, it is extremely important that you kind of look at this and say, hey, look, do I want to get myself caught up in a situation where the LIBOR index jumps up all of a sudden I'm up in some crazy interest rate, and then you'll have to refinance into at that point in time, and then the 30-year fixed rates are really high. So, it's really difficult to it's really difficult for you to gamble like that, in my opinion. So, it's impossible for me to sit here and tell you, well, what are the interest rates right now? There's so many factors that go into interest rates. You have to, say the APRs, all that kind of stuff. But I mean, at the end of the day, you really need to investigate if a 30-year fixed is right for you right now. Look at your current situation. Look at where the predictions are going. Look at what people have said are going to happen in the interest rate to the interest rates, and then make an educated decision. Don't get caught like a deer in the headlights, wishing that you would have listened to me and saying, "Oh God, I remember on the Michael Gaddis show when he told me to, do a 30-year fixed or look into it or something like that." And I thought he was silly. Don't get yourself caught up where you're going to hear that in your head, because at the end of the day, you got to watch out for your financial best interest, and getting yourself into a good, solid fixed interest rate while they're still so historically low should be at the top of your priority list. Well, this has been the Michael Gaddis Show on AM 1170, The Answer, and I appreciate you all listening, and I will see you guys next week.